Are low yields effectively pressuring people to stay in stocks, even if they don't want to be? Well, listen to what Yale professor Robert Shiller told us yesterday.
If I'm asked to predict how you will do investing in the stock market for the next 10 years, I mean, it's probably positive. It's, probably something better than the federal funds, better than the Treasury securities we have now, which is at 2.13% nominal.
And welcome to Trading Nation. I'm Brian Sullivan. Max Wolff with 55 Institutional and Rich Ross with Evercore ISI. Max, listen, he makes a point that he wasn't overly bullish, more just, you're going to beat bonds. What do you make of what he has to say?
Well, I mean, certainly it's hard not to be blown back by the sheer vigor and energy there. But look, I do think
your
that
sarcasm is noted.
Okay. Well, look, I do think it's true that over almost any 10-year period, that's the smart money bet. And it does look like, as much as there's some issues with valuation in the equity markets, those issues are in the bond markets too. And if we are going to see a little bit less central bank largesse, that's likely to fall harder, faster on the fixed income space than it will in equities.
Okay, Rich Ross, let's strip the emotion, the vigor, if you will, out of that statement and look at charts. I mean, I don't know, do you have a crystal ball that can peer out 10 years?
The closest I could come to a crystal ball is a very long-term chart, almost a 35-year chart of 10-year yields, Brian. And of course, when we pull up that chart, we see a downtrend. Clearly, starting in the late 70s, 1980, if you will. And look at this, Brian, even on a
It's been
monthly,
a generational move, right, Rich? I mean, there's no other way to call it.
It's almost two generations at this point. It starts with Reagan with that head and shoulders top. It really starts with Carter into Reagan and works its way lower. So you have this Reagan head and shoulders top into a potential Trump double bottom. The irony of the bookends there, Brian, and that 150-month moving average, that big smoothing mechanism, is your key resistance really for the entirety of the downtrend. And ironically, it comes in around that big magic number at 3%. So what's all this telling you? It's telling you that at some point, Brian, we'll probably make it back up there, but there's nothing in the short term that is telling you that yields have any urgency to go higher. And to the point about stocks and bonds, that tango, if you will. So yes, why are interest rates low? Growth is low, inflation's low, crude is low. So all of those things which don't exactly have this whiff of economic vitality. So what do people do? I have to go buy growth stocks. So it's this bitter irony here that the low yields are pushing people out onto the risk spectrum. We have this barbell of a market with defensives, healthcare staples, utilities leading because of their yields on one end, and growth stocks, high beta risk on the other end. So how do we square it, Brian? I'm not 100% sure. Right now, I would sell growth stocks and I would still buy bonds in anticipation of lower yield until proven otherwise.
Max, I'll go back to you. Comment on what Rich said. Agree, disagree, different view?
Yeah, so look, I think that on the medium term to short term, we would agree. The truth is that the fixed income market is making one economic forecast, the equity market's making another, but the equity market is making the same forecast it's made for 9 years across change in every single variable that it allegedly makes these forecasts on. And in terms of who's a better economist, although they're more skittish, it's hard to bet against the fixed income space on the equity space in terms of intermediate to short term macro forecast.
All right, Max Wolff and Rich Ross looking at maybe a multi-generational trend, perhaps a change. We appreciate it, guys. Thank you very much. For more Trading Nation, be sure to check out Power Lunch, 1 to 3 p.m. Eastern Time on CNBC. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.